Wow, today is Wednesday.
You're now live.
We are now live, and this is Senate Finance. It is Wednesday, January 12th. And today, committee tomorrow, I have e-board at 1:30. You are going to be doing the Cannabis Report. Bryn Hare will be with you. She says she needs an hour and a half, after which you have a break, and by then I should be back with you. Senator McDonald is going to preside. And again, if anybody thinks of any information they need, we've got the governor's budget next week. After that, we know there's more tax proposals in there. There's also a child tax credit that Representative Ansel has put in, so we'll start taking some testimony on all of those. Also, once we've had the e-board, we will spent an interesting money chairs today trying to differentiate between one-time money, which it looks like we have some this year. Next year, there'll be an increase in the base, but once, if I'm remembering correctly, once we get back in, they're looking at a 2%, 0.8% 3 years out. So what we suspected is that revenue increase that we've seen is going to go back to our usual, they call it the alligator jaw, where the expenses always seem to go up just slightly more than the revenue. So as we look at taxing capacity and spending, we're going to try and get a handle on all of this. We will be getting an update. I'm going to try and get it in as early as next Monday on the impact of the pensions on the ed fund, because of the influx of one-time money, especially into pre-funding the OPEB, the health insurance, that it looks like not going to have a jaw-dropping impact, but they're still trying to figure out with the treasurer which year that impacts, because we put money in this year, but your payments are based on last year's numbers. So trying to figure out exactly how any impact from one-time payments in and increased payments will impact the ed fund, but they should know by the end of the week, and we'll have them in next week. So today, yes, the feminine hygiene products. The first thing we're going to do is change the name of that bill. This is the corporate income tax. The corporate tax changes that we had a meeting on in October, in the fall, and thought we'd walk through that. Again, Abby is here to walk through it with us. Like to get, if we can get this one out, it might be a good one to just clear if people are comfortable with it or not. But Abby is here, and we'll take a look at it and see what we want to do. If we aren't comfortable, we'll see what we need to see to get comfortable, or to decide we're never going to be comfortable. So Abby, the floor is yours.
Thank you, Madam Chair. For the record, Abby Shepherd, Office of Legislative Counsel. There are quite a few documents under my name that I'll just give you the quick spiel so you know, to sort of orient everyone. As Madam Chair just mentioned, we did have those 2 meetings last fall, so I've included the presentations that Graham and I gave. Those are S53 corporate tax and then S53 pre-written computer software. We didn't plan to walk you through those again, but they're there for background. And if we have any, refresher questions, just feel free to stop me and ask questions, and we can refer back to those as we need to. I also have the S53 House Proposal of Amendment link, so that gives you the actual language. And then I have a section by section, which is what I'm really going to use today.
Okay.
And that only really looks at the corporate tax changes and the cloud changes. But I also do have my own sort of running tally of what I would recommend the committee change, at least technically, if you want to move S53 forward, because now that we're in a new session, there are different dates. And of course, the feminine hygiene products exemption was enacted. So that would need to be removed from the bill.
Yes. And can we change the name?
Right,
This
so
one isn't even close.
Madam Chair, I know there were discussions, I believe when we discussed this last fall about the streamlined agreements.
Yes.
I don't know if you want to get into the feminine hygiene products discussion straight away or save that for sort of the end of test.
I have not seen a letter. Basically, I reported back to the committee at some point, as long as we have the same definition, they don't care what we call it, and it won't be a problem with the streamlined tax people. And he said they would send us a letter confirming that. But so let's see. Yeah, have we got anything that would propose changing the word? It was the title, right? From feminine hygiene to, what was the title we wanted?
Another expression that has been used, I think, mainly on the floor when this discussion came up, both in committee and on the floor, was using the terms menstrual products instead of feminine.
So I thought the committee was pretty united in that, and if it's still attached to this bill, maybe you can just, somebody, I don't know, it's probably my car warranty, that you can probably just add that in. Does that work, committee? And change the language in the law, and then because that's now gone through separately. So we'd have to amend what we did and then just strip the title. I think we can change title, right?
Yes.
There's something we can't change, but I thought we could change title.
Title you can amend.
Yeah, so let's amend the title.
Can't change sponsors, can we?
Oh no.
Everybody knows that my deep desire is changing corporate income tax structure.
Yes. Well, you might like this one. And the cloud tax is still attached to this, right? Which tends to be more controversial and could be a red flag for a red pen. So we can talk about that as we go through, and if we want to do both bills together. The commissioner is coming in later. One of the issues is, would these corporate changes cost money? And as numbers are being refined, that estimate is also being refined, perhaps to zero or close to zero. So we'll get the latest numbers from him. So I think today, let's start with the corporate tax, and you've got an outline. Can you share that? Might be the
yes.
Would that work better for folks?
Great. We'll share with you. Because I'm using my iPad, I can't see.
Okay,
you.
so we will
So-
just bring it up on our own then. Okay,
Oh, I can share it with you. I just will need you to interrupt me because I won't be able to see you if you're trying to get my attention while I'm.
yes. And I can see two people usually. So holler politely and we'll get your question. All right.
Great. Can the committee see my screen? I have the section by section showing now.
I can, yeah, can assume others can.
Yeah.
All right.
So the first few sections that I'll walk you through are just on the corporate income tax. So because it's a House proposal of amendment, you're not seeing every single provision that was in FS 53. But we're going to start with what was section 3 in the House proposal of amendment. So this section deals with corporate income tax definitions, and it deletes a few definitions, mainly references to overseas business organizations. This is the statutory language that allows for what's called the 80-20 rule, which is actually in regulation. And the 80-20 rule is imposed so that overseas business organizations, these are still US incorporated corporations, when they have 80% or more of their property and payroll and wages outside of the US, they're allowed to exclude their apportionment factors from the Vermont numerator. So I apologize throwing you right into the math right from the beginning, but the effect is to allow these US incorporated corporations to exclude certain income from how they're apportioning their income to Vermont. So it's changing the calculation. This repeals it. So it would pull in those 80-20 businesses back into Vermont. So I'll pause there. Sorry, because I can't see you. I don't know if there are any questions on that.
Any questions on that one? So that really is pulling more corporations into this.
For the purposes of determining which income is apportioned to Vermont.
Okay.
The second change related to corporate income taxes in section 4. And this, oh, I'm sorry, yes.
Senator Brock.
Going back to section 3, in terms of pulling this income back in Vermont, do we have any sense of what we're talking about in terms of amounts?
I'm not sure if I can answer that. I don't know if Graham can as
It
well.
might be a question for the commission.
This is Graham Campbell from the.
Oh, for
currently-
Commissioner Bolio, unless Graham has it.
This is
Top
Graham
of
Campbell from the
head.
Joint
Here,
Fiscal
I will
Office.
stop. That might help.
I guess the long and short of it is, with certainty, no, we don't know. There is nothing on the tax return as it currently is comprised that requires any company to report how much of the sales of the subsidiaries are coming from 80-20 corporations. So we don't actually know with certainty how much money we're missing here. Generally, in the fiscal note, when this was passed and the tax and I are still looking into this was considered a positive revenue change, just because it's requiring more income to be considered for the sales factor. And so it will generally, this obviously will change with every corporation. There's high variability here, but generally on average, it will make sales factors larger essentially, and therefore increase the sort of percentage or amount that's apportioned to Vermont. So it's generally considered a revenue up, but we're still working on the exact amount. I wouldn't count on significant amounts of revenue is what I would say at this point in time.
Well, I mean, this is a question which I know that I'm going to save until the commissioner and others who will touch on the substance of the bill. But always when I look at new provisions or provisions like this, I ask, why are we doing it? And what's the impact? And are we in line with what others are doing? And questions like that in general.
Mm-hmm.
I think those are absolutely fair questions to ask. I would say, in terms of the why are we doing it? There is concern. So I wouldn't say, but just generally, why would a state, have a provision like this in the tax code, and the reason is for tax avoidance, and that's, if corporations and their subsidiaries are setting up, overseas business operations so they can get around states that don't have provisions like this in place. The multi-state tax commission, when they came to the Ways and Means Committee, somewhat recommended that this, is a hole in Vermont's corporate tax code. So generally, the reason is to loop in and prevent potential gaming of the tax code.
Thank you.
Okay. And we'll have the commissioner go into this when he is with us. Okay. So, Abby, you?
Okay, I will share my screen again. Sorry.
Yeah.
Laborious. Okay. So we're back to the section by section. The next provision is section 4, and it amends the existing minimum corporate income tax. It creates new gross receipts brackets and then changes the minimum tax amounts. And I've listed, first I have the new brackets and amounts, and then underneath I've added what they are under current law. It's actually perhaps a little bit easier than looking at the language to look at it this way. And I did make a note that there's a $75 minimum corporate income tax for small farm corporations. That's not changed under this bill.
Okay, so basically this bill will give a discount to the smaller.
That's correct. So it's split out. It's,
And yeah, it splits out into more divisions and significantly raises the minimum amount as the income of the corporation gets larger. So
Yes.
the largest corporations would be paying between 6,000 and 100,000, whereas right now it's 500 to 700. And actually, the smaller corporations don't pay anything. So this puts it spreads it out. It puts a tax on all corporations, right?
so this does impose, as under current law, it starts that even if you don't have a tax liability, you do need to pay the minimum tax. So this is either this amount or what's under the brackets. So there is a bracketed with marginal tax rates in this same section. This is just if, it's the greater of one, the bracket for this amount.
Which
May I ask
might
a question?
encourage you to file. If you might.
May I ask a question, Madam Chair?
Yes.
In terms of minimum taxes, does this apply solely to C corporations or all corporations?
C corporations. This is purely the corporate income tax. So it does not apply to S corporations. Those are considered pass-throughs. Yeah, so all of these changes only apply to C corporations.
I thought it also applies to LLCs.
There are special rules under the Internal Revenue Code where certain pass-throughs like LLCs can elect to be treated like C corps. That they would, yes, under that, as well as I believe sole providers can, certain pass-throughs can elect to be treated differently.
But they can elect to do that.
But typically this only applies to C corps.
Right.
But I had a LLC and I thought I was paying $250 every year. Maybe that was to the Secretary of State.
There are also, yes, so there would be registration fees and then there are taxes. So those are different charges.
There may be a minimum tax for LLCs too.
So who's suggesting this and why?
This came out of the discussions in Ways and Means. So this was a committee amendment by the committee that then passed the House.
I believe the testimony we heard in October was that under this, Vermont-based corporations will will do better, and corporations based out of state will pay a little more. It was really working, and we've got the tax commissioner coming in, and he can talk to us about that too. But it is looked at a way to kind of, I believe the term export tax liability has been used, but to export it to out of state. These are C corps as opposed to in-state.
So, Madam Chair, that's actually a great point. It leads into the next section that would move Vermont to the single sales factor approach. And what you're talking about is exporting, not so much in that it would be like a discriminatory imposition of tax on out-of-state corporations or taxpayers, but more so that by shifting the apportionment factors to sales only, which this bill does, it eliminates the property and payroll sales factors. That means that corporations that are making sales into the states, that income is now going to be 100% determining their apportionment factors into Vermont. So it's more the effect is that businesses that are located in Vermont but make most of their sales out of the state would benefit from this. This language also repeals what's called the Throwback Rule, which gets a little complex, but the basic premise of it is that where there's something called nowhere income, which is income from sales of tangible personal property that are made from Vermont, but that are not taxed, either because the sales are made to the federal government or more typically because the corporation is not taxable in the other state where the sale is made. That is, under current law, those sales are thrown back to Vermont, but this repeals that rule. And that interacts with the next section, which deals with moving to a different method of applying state jurisdiction to income, which is called, currently we have the Joyce Rule, and we'd be moving to the Finnegan Rule. That sort of works in tandem. So it gets rid of this Throwback Rule. It would require taxable C corporations to continue to report property and payroll. And this was a request from, I believe it initially came from JFO to be able to continue to have data on the corporations that, currently are reporting their property and payroll under the apportionment factors, but will no longer be reporting it because they will only be basing their apportionment factors on sales.
Okay.
So this next section does again deal with determining whether Vermont would have jurisdiction over the income of corporations within a unitary combined filing group, even those that don't have nexus with Vermont. And the Finnegan Rule, I didn't have as much detail in here as I had before. I'll just sort of put this between a couple of sections explaining the bill. So the Finnegan Rule treats a unitary combined filing group as one taxpayer. So when any member of the group has a nexus with Vermont, the sales of tangible personal property into Vermont are all considered part of the apportionment factors in Vermont, even if so if you have one member who has nexus in Vermont, all of the members of a group are considered to have nexus in Vermont. Also in section 6 of the bill, just wanted to point out that in my notes, we've also mentioned that the 80-20 rule is also included, it's superseded in this language. So it requires all taxable corporations that are incorporated into the US that are part of a group, unitary combined filing group, are included in that group's return. There's also a note here about state tax credits not being allowed to members if they're out of state. So it includes, it's only for those members who hold the credits. So out of state member couldn't get a Vermont tax credit unless they are in Vermont. That is a recommendation that came out of the Multi-State Tax Commission, not specifically to Vermont, but that was included in some of their model language. I'll pause there because that's really the meat of the bill, and a lot of the discussions, let me just pull this back up, are relating to the single sales factor, and Graham will talk more about the the fiscal impact of that, but also the move from the Joyce method to the Finnegan method. And I don't know if we all remember, if
Okay.
everyone knows.
Yeah, Abby, what is the Joyce method we're on now?
So the Joyce method doesn't look at the unitary combined filing group as one taxpayer. It looks at each, even though
Okay.
the premise of unitary combined is to, have one return. It looks at each individual member's jurisdiction with Vermont, whether they do or do not have nexus with Vermont. That's where you get into these complicated throwback and throwout rules. Vermont just currently only has the throwback. So
Okay,
it depends on depending on which method you use, Joyce or Finnegan, it changes the apportionment factors and what income is included in the numerator versus the denominator. So it changes the
say
calculation.
numerators and denominators. You just lost me. I've gone into
Yeah, sorry, I don't want
second
to go.
year algebra panic.
The most important change happening in this section is moving to a single sales factor. So it's repealing, so currently Vermont has the three apportionment factors: property, payroll, and sales, and Vermont
Yes.
double weights sales. This repeals all of that and only retains sales. So only sales by the corporation or the unitary combined group will be taken into account for apportioning income. So if you have a company that is making a lot of sales out of state, you won't be looking at their property and payroll anymore for
Okay.
apportioning. Vermont.
Which is how this benefits Vermont-based corporations. If I'm a manufacturing corporation, and I'm manufacturing things that are used in automobiles, most of my sales are going out of state because I don't think we have any car manufacturing in this state at this point. So my sales are going out, but I'm also going to my property, which could be extensive, is taxed. This is just going to sales, right?
Right. And again, it's just determining which income will be apportioned to Vermont. It's not the final taxable that will be
Right.
taxed.
Okay, so we're going to sales only, whereas before, if I had a significant manufacturing facility in Asia, but I sold a whole lot of stuff into the state of Vermont, my sales got apportioned, but not my, anything to do with my facility, my land. So that's how this benefits Vermont-based.
Yes. And on your example, that company would have likely been excluded anyway because of the 80-20.
80-20.
So that's
Okay.
why there are so many of these different moving parts as they all work together. So, logically repealing the 80-20 rule would then pull in those US incorporated corporations that are primarily outside of the US when they're making sales into the state, then that would be included in their apportionment factors.
Okay, and this is all based on an effort. It's going on internationally to try and get some control and equity out of major corporations. This is not probably our little machine shop that's, got 5 employees, but major corporations to find tax shelters. Around the world, I know that there's things going on internationally to at least try and get some taxes from major money corporations. And this is a way to have more of the corporations that are selling in Vermont, but not based here, pay a larger share of the corporate tax. Is that rather than hiding it on an atoll somewhere in the Pacific or sheltering it on an atoll. I think that's what's going on. And I've been told by the chair of the House committee that the minimum tax is also crucial to this. And I think we'll have, that's probably in Graham's presentation,
Graham-
but yeah, how the money all balances out. This is not seen to be a windfall, right? We're not making a lot of money on this one. Am I correct? That this is more a readjustment?
Are you speaking for the overall corporate tax bill? Or are you
Yeah, the
speaking for?
overall changes. Is this seen as like a major income or, you know, windfall to the state of Vermont, or is this seen more as an adjustment, which actually we were talking about losing some money. So that's right. It isn't a major windfall.
The overall corporate changes are projected to lose, or as they were in the fiscal note, they're projected to lose money by at least a fair margin, about $10 million a year. But those estimates are to be updated, and I'll go through that in my presentation.
Yep.
So
we aren't doing this to get a lot of money out of international corporations. We are doing this to kind of adjust the scales in favor of Vermont-based corporations, which provide jobs and other tax revenues, all those things we hear about when we do tax credits to the state of Vermont. That's my understanding as to why this is being done. Well, you can't tell why, that only we know why we do what we do.
I think the strongest, there are the 5 pieces in this bill, and the argument that is the strongest for exporting your tax base is to switch to the single sales factor. That's primarily what, I think you're referring to, Madam Chair, about
Right.
switching to others, or exporting your tax base.
It's the base word I was missing. It's not burden, it's the tax base. It's who we are taxing.
Yes, and I think the other changes in the bill, the impact is, I think, a lot less clear. And I think overall, the impact on corporations will highly depend upon how they're structured. So I think it's a general decent rule of thumb that Vermont businesses with large property and payroll presences in Vermont will pay less in taxes under this bill. But I would probably caution the committee about sort of thinking about Vermont-based businesses versus not Vermont-based businesses, because within our corporate tax base, a company that's going to receive a very large tax decrease under this bill might not necessarily be someone who we would consider a Vermont company per se. This is a company that has, say, 0.1% of its national sales in Vermont, but 2% of its payroll and property in Vermont. Okay. And so, do we consider that a Vermont company? It's just the question is, what is the ratio of those payroll and property to the sales in Vermont? And so the companies that will benefit are those with a payroll and property that is greater than their sales right now. And so that's the single sales. And then overall, the other pieces, it really depends upon how they're structured. I think generally the repeal of the 80-20 language and the Joyce-Finnegan methodology will affect larger corporations, just because smaller corporations don't tend to have many different subsidiaries. They're just less complex businesses. So I think that's probably a decent rule of thumb. But as I said back in the fall, the impact about who will pay more and who will pay less is not, I wouldn't say as straight, clear cut as as well. If you're a Vermont business, you'll pay less. If you're not a Vermont business, you'll pay more.
Okay, yeah.
And the other thing too is I think the corporate minimum taxes might actually, have a notable, it's like a wrench in the analysis here because, as it sits, about anywhere between 75 and 80% of corporate taxpayers do not have a tax liability in a given year, which means that they are paying the minimum tax. And so, the question about whether the single sales factor and whether the other pieces will affect a business, the first question you have to ask is, well, do these businesses typically have tax liability? And the answer to that is no. Then the corporate minimum tax changes will affect them. If the answer is yes, then it's a question about how they are structured. So I'm sorry for the sort of more nuanced part of this. It's just I would really stress that the corporate income tax changes are it's not as clear cut as sort of saying you're clear winners, you're clear losers. It kind of just depends on how the business is structured.
All right. So Abby, let's go back and have we finished up your section by section, and then we'll go to Graham.
There are a few other sections here. It's more about transitional language and rulemaking. Would you like me to share my screen again, or would you like me just to review it? They're fairly quick.
Yeah, let's just review it quickly. I think it's going to Graham and still trying to wrap our head around what we're doing and why.
Great. So these, there are three other provisions related to the corporate income tax, and then we'll talk about cloud separately. There's
clouds
one at a time.
Separate issue. Yeah.
They're both complex in their own way. So there's a transition period from Joyce to Finnegan, and the dates are another issue to talk about in terms of any changes to the language. But under the draft sent over from the House, starting January 1st of this year, Vermont will use the Finnegan method, and it just sets out how that would work for taxpayers. So it makes it clear that if any member of a unitary group has nexus with Vermont, then sales of tangible personal property into Vermont by all members of the unitary group will be included in the sales factor. The second administrative section here is relating to rulemaking, and it requires a report by the Department of Taxes. So it allows or it requires the department to adopt rules relating to these new rules. They do currently have an apportionment reg that they just updated actually last fall. So it would require new rulemaking about that, but it would also require a report. And this is where the dates are important. Under this version, it was pushing out all of these changes by a year. Now that we're in a different session, it's now would make it immediate. So this report was required January 15th of 2023 to give the department time to implement and then come back with any recommended changes. So that's it for the corporate tax. Again, the effective dates would be now if they were left in the there.
So we'll need to move some dates and change the title. Committee questions at this point as to what we're doing or attempting to do. Okay, I'm going to go on to Graham, and the floor is yours, Graham.
Thank you, Madam Chair. For the record, Graham Campbell from the Joint Fiscal Office. I've posted a document on the committee's webpage, which essentially reflects the estimates as they were in the fiscal note for S53, but I've made some notes and I'll explain those. Madam Chair, you'd like me to just talk about the corporate ones for now, right?
Yeah, I think if we can get our heads around the corporate one, that's going to be enough for today without trying to do the cloud tax at the same time, or pre-written computer software at the same time. So yeah, we've got revenue impact. So there they are. They're on our website. Okay.
and I'm not sure if I can also,
Can you share
yeah,
it?
let me see here. Share screen. Does this look right?
Yeah, it could be larger.
Okay, let me zoom
If
in
you
here.
make that larger to be good.
Even one more, Graham.
Yeah,
How's that?
he's got good eyes. That's good.
Okay. So this is, as I said, these are the revenue estimates that we made back in the spring of this year. And I'll sort of get out in front and say that these are almost certain to change. The main reason is we will have better information from the tax department for tax year 20 on which to make estimates for particularly the change to the single sales factor. And the reason why tax year 20 information is important is because 2 years ago, the legislature made a change to the way that Vermont treats the sales of services into the state. More or less, a quick and dirty is that companies that were selling services into the state, Vermont would not consider that a sale that's attributable to Vermont unless what we were attributing to Vermont is where the service was created. So if you think about, I think at the time it was Expedia, I was using the example. At Expedia, customers from Vermont would use the service from Expedia, and Vermont would attribute those sales to Washington State because the software that Expedia is, designed in their headquarters in Seattle. Vermont made a change 2 years ago to say that basically for the delivery of intangibles for most part of services, the sale be attributable to where the service is delivered. And so for something like Expedia, it would now be attributable to Vermont, to where the service is delivered. And that's important because it really changes the sales factors in Vermont, particularly amongst industries like finance, insurance, information technology, stuff like that. And so the sales factors on which we were basing the model before were under this old methodology, and we have 1 year of new data. And so I think it'll change the estimates. And I can say, I don't have a number yet because I need to work with Tom Cavett on these, and he's been working on the forecast. But our preliminary look at these is that the change to single sales factor will be less negative than it is on this sheet. But I can't say exactly to what degree. So that's the first change that I would say. So the change to single sales factor was negative back in the spring. The throwback repeal, I don't expect these numbers to change significantly as I update them. So there's a revenue decrease of about $850,000 once fully phased in. The repeal of the 80-20 language, at that point in time, we didn't have any information about the impact that this would have on sales factors in Vermont, primarily because companies aren't required to report sales from overseas business operations. But since then, myself and the tax department have found information that other states made estimates on this. And so we're sort of vetting that. So this number will be positive, but the size of which is not clear. I wouldn't expect it to be more than $5 million though, when it's updated. The Joyce to Finnegan methodology, this was expected to raise revenue for Vermont, about $6.4 million once it's fully phased in. This estimate will be updated with some new information that I've pulled from other states. I don't expect it to change significantly, but it'll likely be different. And then the corporate minimum tax changes, again, these will also likely change because we have a new tax year on which to base the numbers on. So previously, I was using the average of the taxpayers from tax year 18 and 19. And now I will be able to incorporate another year of data, but the data for tax year 20 is not completely in just yet. It's mostly done, but that's why I've sort of been delaying making these updates yet. So another key thing I want to point out is that on the notes thing, all of the effective dates in the bill are somewhat, I won't say irrelevant, but you see fiscal 22 here, it's roughly half of the revenues for a full fiscal year. That's because the effective dates were for January 22nd or January 1st, 2022.
Okay, yeah.
So that's something that I think the committee should consider. If the committee wants to keep the sort of same construct as the House did, my understanding of the reason why we had effective dates that were pushed in the future here was a combination of, one, it gives the tax department a little bit of time to prepare for these things and corporations to prepare, but the other, I think, was more practical in nature about, you know, the amount of money that was available in FY22's budget. And so by pushing it out, the effective date, you're able to lessen the impact in fiscal year 22. So I think that's something that the committee should probably revisit, whether it makes sense to do a half year effective date or to just, you know, make it effective starting, you know, in January 1st, 2023.
Okay. Questions at this point? All right. And if I'm remembering correctly, corporate taxes are very hard to predict in any one year, that they get paid and then we end up making huge rebates. They can say, well, I overpaid this year, so just carry it forward. And they do that for 3 years and we owe them a lot of money, and adjustments have to be made in the budget to pay that out or in the revenue forecast. So this is a lot more complicated than individual income taxes, which are fairly straightforward. And these are C Corp, so probably as complicated as anything. Anything from the committee? Any questions? Okay. So Graham, the long and short is we still have a moving target. I am not seeing Commissioner Bolio here with us yet.
Senator, my apologies. Commissioner Bolio is not able to make it, nor is Deputy Commissioner Samaroff.
Ah, okay. So they're on, well, good, because I was getting nervous that we were running very tight on time. So they were not able to make it. So maybe we will reschedule them and have them come in. Oh yeah. So where was I? They're not on this agenda. So where was I looking?
I removed them.
You removed them. Okay. It wasn't me. It was your delete button. Don't confuse me. Okay. So we are scheduled at 2:30. Do you have any questions that you would like answered for this? No. Senator Sirotkin.
I was just looking at that chart. I thought we were going to get to the next line down. Maybe I missed it on mutual funds.
Okay. Graham, are you still with us? Yes. Can you talk to us about mutual funds?
I can talk to you about mutual funds. So there's a proposal in the bill, and I think Abby could probably flesh this out a little bit more, but it raises the initial and renewal fee for financial institutions if they want to sell mutual funds in the state. So we receive a significant amount of money from these mutual funds, from these financial institutions, if they want to sell mutual funds in the state. And this essentially raises that fee. I need to remember exactly. I think it's to 1750 for renewal or along those lines. So it's essentially raising a DFR fee, and the money gets swept into the general fund. So I think it was built in there as a way to help offset the revenue losses from the corporate
Okay, I was gonna say, this is not really connected to the corporate changes any more than the cloud tax. They were put in there to offset revenue losses, and I think we should probably have DFR in to talk to us about mutual fund fees. Would that work, Senator?
Yeah, I would. In the meantime, now that the door has been open, I know we did something with brokerage fees 4 years ago that we were somewhat of an outlier in how much we were charging fees to 10,000 more brokers or so, 99% of whom were out of state. And we were able to raise that fee up to the level that other states were doing, and we gained millions of dollars
Right.
in revenue. So I think this is not the same fee, I don't think, that we did a few years ago. But I would like to see, if it's possible, just to get a comparison where we stand in these fees compared to other
Other
states.
states. Okay, we will have DFR in. I know there's a housekeeping bill going through, but I think that's more related to insurance. As far as I know, there isn't a fee bill this year, as there hasn't been, but we will ask DFR to come in and talk to us about this particular fee and how it places us in relation to other states. Is that pretty much what you're?
And this is a fee on financial institutions that sell market mutual funds that include that. What's the nexus to Vermont? So I'm trying to get at.
Okay.
I was going to say, my understanding from last year, speaking to DFR, is that if a financial institution wants to sell a mutual fund, so they put together a fund, a package, in order to sell it, they have to pay a fee to DFR, so DFR can regulate them. And so this fee is paid by those financial institutions. And because there are many, many, many types of mutual funds that an individual in Vermont can buy, that's where the money from this fee originates. And so the financial institution that's selling in other states and wants to do business in Vermont will pay this. And in a state like, say, New York, where they have a massive budget, the fees for this don't really amount to much in the overall state budget. But for a small state, these types of fees do end up generating a significant amount of money. At the time when this was proposed in Ways and Means, I did a backgrounder. I spoke with DFR that changing these fees to the level that's in this bill would make Vermont, I think, the highest for fees for mutual funds in the country. Rhode Island apparently just not last year, but the year before, changed their fees, and this brings us basically neck and neck with what Rhode Island's are as the highest in the country.
Okay. And again, we may not need the kind of money we thought we were going to need a year ago as the things come in updated. Senator Hardy. I see your hand. Yeah.
Yeah, thanks, Madam Chair. Graham, where is this mutual fund fee thing you're talking about? It's not on Abby's summary, is it? I didn't see it on there. It's not on your summary.
No, I think it's on
the-
Graham's.
Because it's not a corporate income tax issue. It's just a separate provision. So if you look in the language that's posted under my name, let's see, that one's S53 House Proposal of Amendment.
Yeah, that's where I'm looking through. What section is it?
So many things open. The fee is at the bottom of the page 11, where it says fees. And after that, there's also another provision that we haven't discussed, also unrelated to corporate income tax, which is an income tax exclusion. So the fees are section 13 of the bill.
Got it. Okay. Thank you.
Okay. Are we set? Okay. We are right on schedule. So we're going to move on to S-169. And Abby is still with us. And this is my bill, but I have no pride of authorship. It's a response to a situation that arose in the city of Barry, but could arise other places with TIFs. So who is here? Carol is here. I'm wondering if it might make sense to hear from Carol so we know what the situation is before Abby walks us through the language. So find out what happened on the ground and then we can walk through. I don't see Peter Anthony. We invited him, but he's probably in his other committee. I know he has a similar proposal in the House. This bill, and I put on for purposes of discussion, would allow the Secretary of Education to make these refunds automatically under certain situations. Representative Anthony just dealt with the city of Barry's situation, but I thought we might as well discuss a broader level while we were at it. So we aren't back next time if St. Albans runs over, or Windsor or Bennington or any of the other communities. So City Clerk Carol Dawes, welcome.
Thank you.
You pop around again. You went from the bottom to the top.
Yeah, people jump around on Zoom
They
screen.
do.
For the record, Carol Dawes, Barry City Clerk and Treasurer. And I'm fresh from House Gov Ops, so I've also been jumping around from committees. So
Different hats.
Thank you so much for taking this up. As I'm sure you know, communities that have TIF districts like Barry City, we go through an audit process with the state auditor's office. It comes up 5 years into your TIF district, 12 years in, and then at the completion of your district. We just completed this past year our first audit. Very pleased with where the audit ended up. There were a couple of calculating errors that this is one of them, and that we're looking to correct. But ultimately, we got a clean report from the auditor's office. There were a couple errors with regards to calculating education taxes. It's not even so much errors as timing issues. There are, in one instance, we had a property that a brand new building that was on the grand list for X amount of money. And they appealed to the Board of Civil Authority and ultimately appealed to the Department of Taxes Property Valuation and Review. And that didn't get settled until the spring of the following year, but the grand list had already been lodged, the education taxes had already been calculated. And so it ended up creating this discrepancy down the line that there was no mechanism for fixing in the time frame. We did have a couple instances where through data entry errors on our part, there were instances where both we overpaid the education fund, and in a couple instances we underpaid the education fund. I gave some more details in the memo that you have available to you, along with a copy of the table, the summation table from the audit report that shows that the amount overpaid by the city to the education fund was $20,962. And that's the amount that we're seeking as a refund. We certainly feel confident in that number as it was calculated by the state auditor's office. However, as Senator Cummings mentioned, there is no mechanism in place that allows the Agency of Education to make these corrections, and that it does require legislative action, which is why we're before you today. There is precedent for these kinds of corrections as recently as 2 years ago in Act 122. The legislature granted similar reimbursements to the Bedford School District, the town of Brandon, and the Windsor Central Unified Union School District, again, through calculation errors, et cetera. And that's, I think, the reasoning behind Senator Cummings' additional language in the bill that would create a way for the Agency of Education to grant these refunds under certain circumstances. As Senator Cummings mentioned, there is a similar bill over in the House, H508, which was introduced by Rep. Anthony and Rep. Walls, but it doesn't include sort of the corrective language. It just deals with the city's refund request. But we would certainly support the idea of putting some kind of corrective process in place so that other communities and school districts that find themselves in similar situations going forward would have a quicker, easier path. So.
Unmute. Okay. The bulk of your problem, because we can get into who's responsible for data input errors. But the bulk of your problem is you have a big new building downtown. The grand list was set, you had it assessed at a certain amount. It worked its way through the appeals process locally and at the state level. And I guess they could have gone on to the Supreme Court if they wanted to. And that takes some time. But that amount got reduced at the state appeals level, and you had already paid the tax on the greater grand list. So now you have overpaid, and the auditor has ascertained that you have overpaid $20,000, which in a city like Barry is a significant amount of money. So committee questions. Ms. Dawes, Senator Hardy.
Thank you, Madam Chair, and thank you, Ms. Dawes, for coming. This actually, now that I'm thinking of it, may be a question for Abby. It's because it's about the language in the bill. I don't know if you want me to wait or ask her now, Anne.
Let's see, are there any questions for Carol or what happened in Barry? And if not, we can go on to Abby. It's good. This is all that happens given the results of the audit in St. Albans. You should feel really good. Okay. Abby, why don't you walk us through this bill and we'll see what we have.
And then I'll take questions. So I don't know if I need to, no, I don't need to introduce myself again for the record. We haven't gone off live stream. So as Ms. Dawes just presented, the impetus for this was the auditor's report. So it took the amount from that, it's almost 21,000. In the first section, it refunds that to Barry City for those TIF overpayments. And as she mentioned, 2 years ago in Act 122, there was a similar provision to compensate multiple towns and school districts over the course of several fiscal years for small errors, very similar to this. There was also a 2017 bill that compensated the town of Georgia for an erroneous classification of certain properties. So these small fixes do pop up occasionally, not very regularly, but they have happened over the past few years. There is a general payment authority for the Agency of Education under Title 16, Section 212, that requires the Secretary of Education to supervise the expenditure and distribution of all money appropriated by the state under the provisions of Title 16 for public schools. That requires the state to first appropriate money. It doesn't provide the agency direct authority or discretion to make refunds or specific payments. There are other types of payments in the Ed Fund section and chapter in Title 16, but none of them really appear to apply to this sort of situation where it's more of a clerical or administrative error or miscalculation. So the language in the first section notwithstands the Education Fund chapter 133 in Title 16, and then it requires the transfer to the city of Barrie to happen no later than fiscal year 23. The second, so I don't know if there are questions about that section or if I should move on to the other section in the bill.
I am not seeing any questions.
And again, as Ms. Dawes mentioned, there is a bill, it's H508 in the House that it has been introduced by Representative Anthony, and it has identical language to this first section in it.
We want to make sure that the state pays out.
In sections 2 and section 3, this is where the ongoing authority is given to the Secretary of Education. It creates the ability of an ability for the Secretary to authorize refunds. It's not a requirement, it's a discretionary may authorize refunds from the Education Fund to a municipality or a school district when that municipality or school district has made overpayments during the immediately preceding 4 fiscal year. So it is limited in time. And those overpayments, the only ones for which the Secretary will be able to authorize refunds, the only sort of the limit on those types of refunds is for overpayments caused by clerical or administrative error or miscalculation. It does require these refunds to happen on or before June 30th of each year. And it also requires the Secretary of Education to report to the General Assembly each year at the beginning of the session of any anticipated refunds before they're actually issued. And the third section is allowing this refund authority within the Education Fund section, because it doesn't currently authorize the Secretary to make any of these sort of payments. It makes it clear that the Secretary has this discretion. And the first year in which this will apply is this year. So it takes effect July 1st, 2022, meaning the first report would be made to the General Assembly next January 15th, and then next June would begin, if there were any reason, any overpayments, the Secretary of Education could make those refunds.
Abby, are these only for TIF refunds or all refunds?
This is quite broad, so it's any overpayments that are caused by clerical or administrative error or miscalculation. It is not limited to TIFs. So, for example, 2 years ago, it was errors in calculating pupils and figuring out their residence, I believe, were the cause for the. There are a few different towns and school districts in southern Vermont that they received refunds for. And then for the Georgia refund in 2017, it was for misclassification of property.
Okay.
So it's
And
very broad. That could be
Yeah.
more specific.
Okay. Carol, I saw your hand up. Do you have anything to add to help us?
And I was going to say, while the errors and miscalculations associated with Barrie City were discovered through the TIF audit process and happened to be associated with properties in the TIF district, they weren't actually TIF related. They were related with the values as established on the grand list, and so they weren't actually associated with TIF.
Okay.
And for a bit of context, in the 2020 refunds, I believe it was the Agency of Education and those towns and school district that identified those errors.
Okay. Okay, Senator Hardy.
Thanks, Madam Chair. You asked one of my questions, which was, is this broader than just TIFs? It seemed like it was. So just having that confirmation is helpful. A couple other little or technical questions, Abby. The first provision that's specific to Barry, is that session law, something that would just be temporary? Okay. And then you mentioned the effective dates, that it would be effective July 1, 2022, but that the secretary would have to report for the first time on January 15th, 2023, except for there would probably not be anything to report because he would have had to have made the payments by June 30th, 2022, and the bill wouldn't have been effective yet.
So it would be for the following session. It's all anticipated refunds. It's not, they must be reported. So the intention to provide these refunds. So for the January 15th, there probably won't be any, but there could potentially be some that were identified. That was put in as sort of an oversight mechanism so that the legislature could take action if it wanted to.
Yeah, it's a
Oh,
$10
I
million
see.
refund to your cousin. We might want to say, wait a minute,
Well, that wouldn't be a clerical error, but
maybe.
okay, that wasn't clear to me. That I thought he was reporting after he'd already made the payments, but it's really a prospective report
Anticipated.
saying, I'm going to make these payments because of these errors. Okay.
That's right.
And then we would have that information when calculating the yield and all this stuff for the education fund. I mean, $21,000 may be a lot for Barry. It's nothing for the education fund. It won't matter at all, but in some cases it might matter.
Or a couple of them could.
Yeah, there are a whole bunch of them, but this year with our surplus, 21,000 really won't make a difference to us, but to Barry certainly will.
It most certainly will.
Okay, I think those were my questions. Thank you.
Okay, other questions? I'm not seeing any. All right. Any other witnesses you would like to hear from on this? We should probably hear from the Department of Education before we pass it out. And if you think of anything else, let me know. Senator Pearson.
I don't feel that strongly about it, but usually it's Tanya or somebody in the auditor's office.
Auditors. That just came to me. I kept saying there's somebody else we need to hear
Maybe
from.
just see if
Yeah.
they care to testify. I mean,
Yep. So we'll be in touch and get those two entities in. I have a feeling the auditor's office may want to tighten this up a little bit. Okay, Carol, again.
I do know that Rep. Anthony has been in touch with both Mr. Hoffer and Mr. Ash in the auditor's office about testifying when the House version of the bill is taken up.
Comes up.
So they're aware and eager to come in and talk about it. So.
Okay, good. We'd love to have Mr. Ash sitting in the witness chair. Might be fun, along with Mr. Sterling. And he will be in. Okay. I think that's it, committee. We are on break until 3:15. Be back a couple minutes early so we can get you all signed in. We're going to go through another one of the LCAR issues, which is the Code of Ethics for Securities, I believe, purveyors. So I'll talk to you in a few minutes. Okay.
Ending